Many promising privately held life science companies are recognizing that the fallen angel reverse merger is an attractive way to go public and raise capital as an alternative to the traditional IPO. This is especially so given the abysmal IPO market we had last year and the very uncertain forecast we have for the current year. What we mean by a fallen angel is that many companies that went public during the last IPO wave ending in 2015 have sort of run their course, meaning that they've failed in the clinic, they've determined they're not going to be successful, they're 18 months out from their IPO, and they now realize they need to shut down their clinical programs and find a way to salvage value for their public stockholders. The two things that they have going for them is they still have significant cash, often have very significant cash left over from their IPO. We've seen amounts ranging from 25 to 50 million. And they also have their NASDAQ listing. A fallen angel reverse merger happens when the fallen angel merges with a promising private company, a company that's got a future, that's got successful clinical programs and wants to go public and raise capital. The two companies don't have to have any similarities in terms of the failed programs that the fallen angel had and the clinical programs of the private company. One could be a cancer therapeutics company, the other could be a liver disease company. In the merger, the fallen angel looks like they're the acquirer, but in actuality, they're the acquiree. And that topsy-turvy nature of this is why we call it a reverse merger. So specifically, what happens is the fallen angel issues shares of its common stock in exchange for acquiring 100% of the private company. But it has to issue so many shares to do that the former stockholders of the private company end up becoming the controlling stockholders of the combined entity, often having 75% or more. And so what you have is at the closing, you have the fallen angel company changing its name to the private company, and you have the private company's management team and board of directors in charge. And so voila, now you have a public company that used to be a private company. So for the fallen angel, their public stockholders get an afterlife. They get another bite at the apple, a chance to realize value. For the private company, this is an alternative to an IPO. They have now become a public company. They've succeeded to the NASDAQ listing of the fallen angel. They've assumed significant cash balances that the private company had, and they may have even augmented their war chest further by doing a concurrent financing with the closing of the reverse merger. We've seen companies do concurrent financings of anywhere from $10 million to $90 million. You see, VC backers of private companies are often willing to double down on those investments when they see it's part of a reverse merger and they're going to get the added liquidity and prospects which come with the NASDAQ listing. Importantly, the fallen angel reverse merger is not subject to the one-year seasoning requirements, which a reverse merger with an OTC shell or so-called true shell company would be subject to. And that's very important because having a continuous NASDAQ listing is very important value driver, and any delay in that listing affects pricing. A traditional IPO takes anywhere from 6 to 8 months and is a very, very uncertain process. It's uncertain because of the time involved. It's also uncertain because of the incredibly fickle IPO markets and valuations for private companies in the IPO process. In contrast, the fallen angel reverse merger takes anywhere from 3.5 to 4 months from announcement, and the valuation assigned to the private company is a matter of upfront negotiations with the counterparty. Many private company folks think that dynamic leads to a lot greater control and visibility over their destiny than if they went down the IPO route. In conclusion, the fallen angel reverse merger is an attractive way to go public as an alternative to the traditional IPO. Any promising life science company should consider whether it's a good fit for them. Indeed, it may be the optimal way for a company to go public and raise capital in these markets.